Okay, good afternoon, everybody. Welcome to the weekly Take on the Market. Today is February 2nd. It's Friday. It's around 12 o'clock Pacific time. Market will be open for one more hour here. I have some meetings, so I can't wait till 1 o'clock, unfortunately. But market's pretty much probably done what it's going to do for the week. So I don't see any craziness, hopefully, in the next hour. I'll be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. The disclaimer, please. I'm not licensed. Nobody at IBD is licensed that I'm aware of. We don't make buy, sell, hold recommendations. Our circle of competence is research, education, helping you to do this on your own. Okay, so market thoughts. We'll do industry groups. We will do some stocks that are on my radar, things that are kind of going on in the markets. And then the quote of the week. You guys know the drill, pretty much same each week. So some of these screenshots are a couple of weeks old. It's been a few weeks since I did this. So this screenshot might be a couple of weeks old, but the thought process is what's most important. The early part of the year was, the junk coming off the bottom, for lack of a better word. Tesla's not necessarily junk, but it is up 100% off the lows. That's going to really drive the indexes and the markets. So Carvana, et cetera, Affirm. There's a lot of stocks that are off their lows, and a lot of it is contributed by short covering. So far this year, what was good last year is bad, and what was bad last year is good. It's kind of been the theme so far here, 5 weeks in. Expectations for the stock market is the Gallup poll. I don't know who they're getting this information from. Is it, are they on the street corner asking somebody? Are these investors? But I just find it interesting, and they've been doing this poll for a long time. Most people believe the stock market was going to go down a lot or a little. And coming into this year, you've probably heard that, that we were going to go into a recession. I think it was the most widely anticipated recession in the history of, modern financial markets. Every economist out there was forecasting a recession. And I know earlier in the year, I said, well, either we're not going to have a recession or it's going to be really bad. Like it's not going to be just a recession. So far it looks like probably the former. We're just not going to have a recession, so that everybody will kind of get caught off guard. And I think that's kind of what's going on with the market. Market's like a seesaw, right? Especially institutional money never leaves. So they're either all in the Apples and Googles of the world, or they all, like me, recognize that these stocks probably have seen better days, and they're all out of them. Problem is, because they're such a big part of the indexes, if you're all out and they start to go up, you could get left behind. So for me, if I go up 2% and the index goes up 10%, that's no fun, but I'm not going to lose my job. I'm yet to fire myself as a portfolio manager of family money. But if you earn money at XYZ or mutual fund, you have that career risk, you have that fear. So it's kind of a different FOMO that the institutional money must have, I think, since they're kind of always invested. If they're down 10% and the S&P is down 10%, there's really not much more they can do. Daily call volume is crazy. I don't know if you've heard of the new thing, the 0 DTE options, which stands for 0 days till expiration. And basically it's a bet on the stock market. I think that maybe the SPY has it. A couple of the other QQQ maybe has them every other day, or IWM. I don't know. I've never traded one, at least not on purpose. So it's really driving volatility in the markets. And you can see the options market explosion recently in number of contracts. Because if you're a market maker, if you're a guy that provides liquidity and options, and people are buying SPY calls from you. In other words, they're buying from you, which means you're short them. You're selling to them without actually owning them. A lot of times they go into the market and hedge by buying the SPY or buying S&P futures. So when they start to get overrun, I'm just kind of guessing. I don't know for sure. It's based on what I read and based on what I know from markets. I've never been a market maker, but yeah, they start hedging. So, the more call volume they get thrown at them, the more they want to hedge. And it seems to be like a vicious cycle that drives the market up and then it drives it down. So you're seeing a lot of intraday volatility lately. And kind of off topic, but I know a lot of people have asked, Scott, you get some quotes, some stuff from podcasts, etc. So I just got back from a hike and was listening to this podcast. I'm going to butcher his name, Joseph Shaposhnik. I apologize, Joseph, but I really enjoyed this podcast, especially the first like 2/3 where he talks about process. The last third, he talks a lot about the companies he owns, but I'm more into the process. He worked at Fidelity, now runs a mutual fund. I think he's with TCW, if I'm not mistaken, but he worked very closely with Will Danoff and Joel Tillinghast. And so it's some of the things that he said are the same things that I used to hear at William O'Neill all the time. So Scott O'Neill used to always say, we're not in the prediction business, we're in the interpretation business. So we're not trying to predict where the market's going to go. We just watch what the market's doing day by day, week by week, and interpret that. And he said, I'm not in the prediction business, I'm in the observation business. So I thought that was very interesting. The same word pretty much. Just so no one knows where the market's going. No one, not me, not Will Danoff, not Jerome Powell, Jay Powell, not the President of the United States, not Paul Tudor Jones. Paul Tudor Jones didn't get fabulously wealthy and have to build that tremendous track record from predicting where the stock market was going to go. In fact, if you read Market Wizards, which is copyright 1988, I think he was pretty bearish on the overall market and economy after the 87 crash, like depression type bearishness. And if he had kept that kind of line of thought, he never would have participated in the early 90s to mid 90s to late 90s, because exactly what he thought could happen didn't happen. So you have to be willing to pivot. You make your best guess, you put your chips down, you might have to pivot, you might be wrong. And it's just a constant observation, interpretation process on what the markets are doing currently. Okay, so let me pull up Marcus Smith. And you should see a chart of the NASDAQ. Remember, the market's not closed, but we've been going down for a number of days here. Market was very stretched, and it's had a pretty good run, to the upside here. So you've got the CPI number, I think, is on Tuesday. And so that probably is creating some trepidation for most market participants. It's unlikely you'd want, if you have the ability to have a big bet down on into that number, long or short. And even for me, I've got a little bit on both sides, and I'm not in any hurry to press, to lever until I want to kind of get through this number, see what happens, and allow the market to digest the gains. So the market's fine. I don't love the market. It's not fantastic, but I have to give it the benefit of the doubt. It's made a pretty good move off the lows here. You've had some, what we call follow-through days. So days that would qualify as a follow-through day if we didn't already have one, which was here. That's the day of the market follow-through. And then you've had a couple of other strong days. So it seems fine. It's a bit stretched for sure, short term, 3,800 to 4,200, and it's correcting that so far. Let's look at the S&P. Gosh, it looks so similar. I didn't even realize the chart had changed. It's just the Nasdaq's a little bit weaker, which I think is the case. I think the stuff you don't want to own is on the Nasdaq. So and it's not that you have to. To me, Apple, Amazon, Google, Nvidia, Tesla. At some point, although Tesla trades crazy, if you're an active trader, it's a great stock. These are really probably avoids long term. That I was talking to a friend of mine who runs a hedge fund this morning, and we were talking about Tesla, and he said, I bet if you fast forwarded 10 years from now, it'll probably be in the same spot. So a lot like Cisco did after its big move off, or Qualcomm after its big move. They didn't go away, but the stocks built huge sideways action. So, but that's what's in most of the NASDAQ is those types of stocks. The Russell, I haven't looked at the Russell in a while. I'm going to use the IWM. It's pulled back a little bit more. And then, two funds ETFs that I was in, but sold into the strength, EMXC. Oops, this is EM. So EMXC, which is emerging markets ex-China. And you can see it's kind of given back some of the gains, and DTH holding up a little bit better. Did give back a little bit of the gains, but they're holding up just fine. So as far as the market action, I was on the webinar yesterday with Ed and Ken, and this type of weekly action up, where you get 1, 2, 3, 4, 5 weeks up in a row. You can even see in here, you never got more than 2 weeks up in a row. You see that one up, 2 up, 1 up, 3 up, 1 up, 1 up, or I should say 2. Near the end here, you got 5, and that was in time for the pullback. So when you get a number of weeks up in a row, it's for an index. The indexes can get a bit overbought. It's different for a stock, right? It's a good signal. It's not a buy signal. You probably can get some kind of pullback as well. But if I look back and remember, this is it's all recency bias. So for me, this is recency. Let me go back to the top in 2000, and you get these huge weekly spikes. 1, 2, 3, 4, 5 of 7 up. 1, 2, 3, 4, 5 up, and boom. 1, 2, 3, very little, doesn't really qualify. But this one, 1, 2, 3, 4, 5 of 7 up, down. 1, 2, 3. What's that? This is about 9 of 11 up, and then boom. They all kept undercutting. And one thing that I noticed about these weeks is always in these rallies, there's a huge week. So in the May 01 I wrote this down. So in the May 01, 5 of 7 here, this one, in this rally, May 01, this rally. Yeah, I think this week was a 10% week. It was 14%. So this one was 19%, I think. Yeah. And in here you had a couple of 7%. And in here, you had a couple of 6%. So I just based on observation thought, okay, well, 5 seems like a solid number. And you get these really big weekly gains, and eventually the market gives all that back. So if I fast forward to when, the bull market started in 03, remember Bill's famous trade in eBay was right in here somewhere. Was when he was buying eBay. Let's see if I can pull it up. Yeah, so right in here, he was buying eBay. This was in September 02. Really started getting going in early 03 but if I go to the NASDAQ, and you have that kind of same feel, right? Number of weeks up in a row, but look at the magnitude of those weeks. much cleaner. If you throw out this kind of jump off the lows, all of these weeks, none of them are more than 5%. That one barely over, but it's all 3%, 2%, stuff like that. And it's just a little tighter. You can see the bars are just much tighter. Like if I were to draw the range here, it's not so steep either. Look at the steepness of these rallies. You see that angle of ascent? I just don't like that type of steepness. As crazy as it sounds, you can manage your risk better if there's less volatility. I can be much heavier positioned if I know I can get out if need to with a you know, a good fill on a stop. And in an environment like this, you can do that. You know that you're not going to come in and be surprised and have the darn thing down, you know, 8% one day. And so I really was hoping the market does something like this. So if we fast forward to where we are now, so just too steep. This one's okay, not bad. And that's partly, look at it actually worked, although it would have been tough, but it held, right? So this is a little steep. I really would love to see the market kind of settle down again now. This is what I want, and I have to be careful because the market. The last I heard, they haven't called me and asked me what I want, I want the market to trade. So you have to trade what I have to be cognizant of it. But I can adjust my position sizes, my number of positions, the types of stocks I buy accordingly. And I don't have the pressure to, you know, if the market's up 10% and I'm up 5, that's fine by me. That doesn't bother me one bit. I'd rather be up 20 if the market's up 10, but that's okay. If I have a thought process, there's a reasoning behind what I'm doing, I can live with the underperformance for a while. For like, you know, it wouldn't bother me for months if that was the case. So I'm kind of just waiting it out. Let's see. I would guess I'm like 60% long, 15% short, something like that. So net, what would that be net? 45% long. I'm just guessing something of in that kind of range to give you an idea on my thought process. Okay. All right. So let's. Oh, okay. I think I mentioned this earlier, but this is a quote or a tweet from the Wall Street Journal. So, and this is a couple of weeks old, so forgive me for the numbers. They might not be spot on as we sit here today, but in the S&P 500, 48 of last year's 50 worst performing stocks are up this year on average 17%. So the last year's worst on average are up 17%. 30 of last year's best are up this year on average less than 1%. So it just a seesaw, right? The money was here and now it's trying to go here, and it'll you know, do that back and forth. All right, let's open up Market Smith with the industry groups. Let's rank them. All right, oil and gas field services is 1. It's been a great group. Tidewater, Weatherford, which I'll pull WFRD. Wow, what a great stock. Ugh on that one. Retail, wholesale, office supplies, 1 stock. Retail department stores, interesting, 6 stocks. Metal production distributor. I don't know that group very well, but I would look at that, but there are only 3 stocks. Let's go ahead and do that. It won't take me but 2 seconds. RYI, Zeus, and P Park, Ohio. You know, unlikely I would do anything with those. Commercial services, leasing, leisure movie, that's Netflix. Machinery, construction, mining, leisure gaming equipment. So a lot of with the opening of China, a lot of the those stocks have come back, like Wynn and et cetera. And I didn't mention it, but let's jump to it. Forgive me, I'm going to call an audible here. But China looks tired. It looks like it's, you know, had a huge move off the lows. Look, 17 to 34 is, if I'm good at math, more than a double. And so it's starting to weaken. Baba, see, it's pulling back off the highs. Pinduoduo, pulling back off the highs, building this ascending base. So it looks like it's if there's another leg, possibly, but they look tired. Mining metal ores, BHP, Rio, stuff like that. Steel producers, oil and gas drilling, VAL has been a great one. Shoes, I know a lot of people are talking about, is it on is the ticker? On Holdings. New, I love the new. The numbers and earnings and sales are really good. I do see them and people on their feet at like the gym and stuff. I don't know if you ever looked. I almost bought a pair. They're expensive. You think Nike's expensive? Try On Holdings shoes, but that's good. I mean, I like my feet to be comfortable, and so I spend a lot of money on shoes from sports because if the shoes start to go bad, I want a new pair. So, you know, it's a discretionary item that I'm willing to pay up for. So that's one of the reasons why Bill has kind of liked these types of groups. So this is an interesting name in that area, and Crocs, of course. So not a whole lot to say about the industry groups. Let's do stocks to watch. So the group that's most interesting to me right now is this group, oil and gas transportation pipeline. So Scorpio Tankers, I do own Scorpio. I never would build a base. It was a frustrating stock. Great opportunity to buy off the 10-week. Great opportunity there. Great opportunity there. You finally got a base. It's a stage one because it never built a base. I would say it's really probably one kind of a base on base here. I really think it's probably a second stage, you know, as far as if pattern rec didn't exist and you handed me this chart, you know, 20 years ago, what would I say? But this is, you know, the big earnings and sales are very appealing to me. Look at those huge numbers. You know, if they do $11 this year and $11 next year, you know, look, they've had years losing money, and now they're just starting to print money. So this is a possibility. And you know, TNP isn't in the same group. It broke out this week. TNK, same group. I do own. It broke out this week. TRMD is building a base, and you see there's a theme here, right? They all kind of look very similar. They're all setting up on bases. They all have big earnings and sales and big relative strength. I don't think you have to own all of them. LPG did break out. I do own that one. That broke out or last week on the earnings report. So, you know, I own 3 or 4 of them, and you know, I'm either going to win on all of them or lose on all of them. I'm pretty certain of that. They're very similar in the same group. So, you know, keep that in mind if you're considering something like this. The reason I'm spread out so far is it's hard for me to tell, you know, who's better. I think LPG is more natural gas, where Sting might be more crude. You know, maybe just, you know, food for thought as far as that. But they're setting up, and it looks like there's, you know, maybe there's another leg higher. Let's look at WFRD. This is stock that I mentioned, and I bought WFRD here and got stopped out. And then when it did this, I kind of gave up on it. You know, I kind of gave up, or I did give up on it. What do you mean kind of? I did. And then a lot like Sting, it just trended higher. This is kind of a base. I think you could have bought like that in hindsight. You've got some tightness here. You'd had to have held into the earnings. But, you know, this is why you want to try to be patient with stocks, is because the best part of the move is always later on. Because these guys are accumulating this stock in anticipation of this. The business is changing, right? You know, and you can see in a chart, they lost earnings or revenues up 18%. Revenues up 19%, but they made money. And then revenues up 278. I'm sorry, revenue up 25 and earnings are up 278. But so you don't want to give up on a stock because you think it's extended. It might be hard to buy, but ACLS, another great example. It's extended, it's extended, it's extended. Yeah, it is extended, but then boom, it's up 10% on the earnings report at one point. So that's from Bill's book. He talk about like the best part of the move is later on, coming out of the base. It's not always so clear that what's going on with the stock. So what else? Let's look at Tesla. Let's look at some big caps. Weekly chart, you didn't quite get to the 40 week. I thought it would stop at the 10 week. It didn't. And so, the next thing I said, well, maybe it'll stop at the 40 week. Didn't quite get there, but close enough for government work. If this stock were to go down or sideways, this would start to roll, continue down, and it'll look like it touched it perfectly. So you have to keep that in mind when you study some of these big winners. Qualcomm, for example, it never really touched the 10-week line, but it looked like it after because it kind of caught up. So you might have to, if you're looking to buy something off the 10-week line, you might have to pay up a little bit for it. And in this case, I was looking to short something, and I might have to, take a chance and be a little early. This looks tired. It's not a Carvana, but if you were to, as far as a business, but if you were to see like kind of the thought process, you see how you see this, so you get these, that's a 61% week, and the following week is up 10%. So it's like this is 20 and that's almost 60. It almost triples from the low before you get the next leg down. And that's kind of my thought process for Tesla. If I'm wrong, I'll take a little loss. I've taken a lot of little losses with Tesla so far this year. But if I'm right, I might be able to grab 20, 30, 50 points, something like that. So I like the symmetry of that. NVIDIA. So it comes out, you've got the power from pivot. It looks a little tired. You can see the weekly volume is going to probably be higher than the previous week, and stock will close unchanged, most likely, give or take next 40 minutes here. Looks a little tired, but AMD looks a little tired. So these stocks have made big moves. Remember, NVIDIA is a $500 billion company, and I think it's doubled off the lows, 108 to 230. So, that's a lot of power. That's a lot of money going into that stock to push that to these levels. And so they deserve to rest at best. The other thing about, so two thoughts. AEHR just reminds me of why I like to take profits, because I'm just no good at holding these. This stock is down 18% off the highs. Now I'd still be up on it because I was buying here on that day and here, and I was buying more there, but it just would be hard for me to stomach that type of 18% move down. So that's normally why I like to sell on the way up. But I am interested in this name. There are plenty of secondary, so I'm hopeful that it does something like that. Next week or two comes down and touches that line. But you have to, the main thing I wanted to say about that is know thyself. So I would rather sell the stock on the way up at 34. I'm just better at that, knowing that it's probably going to go to 36 or 37. Then here at 34, it's the same price, but psychologically it's tougher for me. I don't know why. I've kind of given up on trying to figure that out, but I might hesitate at 34, and then I'll really, sell kind of in a panic at 31. So I might as well just take 34. Some people are good at selling like this. They let the stock top, and they can, it's 37, they can sell it at 34, or it was 40 and they can sell it at 34. I just found that I'm not very good at that. So I like to sell them, on the way up, at least some of them. Maybe I can hold a little bit if I really like the name. But ALGM broke out, doing great. I think I mentioned this one a few weeks ago. I got the idea from Jim Ropel on one of the IBD podcasts. It came down, touched the line perfectly, broke out. It's a very large cup with handle, but so far acting really well. Okay, and then last but not least, the whole AI thing isn't something that it's the kind of the frenzy around it has kept me a tiny bit cautious as well. So, Baidu announces the AI thing, and look at what the stock did. Or AI, it's the ticker, runs from 14 to 30, and now it's given back 30% off the highs. So, and then, the Carvanas of the world, it's hard to even see. I guess you'd have to go to the intraday, but, here it is down there at 4 and change. And there it is at almost 20 in how many days? So the market got a little frenzied very fast. What used to take months to years for the animal spirits to kick up in the stock market, it takes days to weeks now. So you have to kind of be, not that you have to be doing anything or responding to it all the time, but you have to be aware the market pivots very fast nowadays, and have a plan. You might say, I want to hold this for 6 months. I would just say, just have a plan that I want to hold it as long as it's acting right, or I want to hold it as long as it's above the 10-week line, or I want to hold it as long as it does this or that, rather than some time frame, because the market's is on its own time frame. All right, so what do we have left? The quote of the week, right? Mark Spitznagel, he's Chief Investment Officer of Universe Investments. He was on, I can't remember what I listened to, but it was on YouTube. You can search Mark Spitznagel to find it. Any risk mitigation strategy that requires a forecast is just simply doing it wrong. So that was what led me to the whole thing about people trying to figure out what the market's going to do. I would argue, to simplify what the point of risk mitigation, because he kind of went on, but the point was risk mitigation is not so much to protect you from the market, but to protect you from mistakes that you would make in response to the market. That's what's so important. That phrase resonates with me perfectly. I'm constantly trying to protect myself, not from the market, but from the mistakes that I will make in response to the market. Remember AEHR, right? From 34 to 37, back to 34. Okay, Scott, it looks like it's tired short term. I'm more of a short-term trader. Time to take profits. I hesitate. Gosh, it was 37. Why didn't I sell it there? Now it's 31. I panic and sell it all in a panic. So I'm protecting myself from making that mistake 3 weeks later by selling it at 34 on the way up. And I'm just kind of, I don't remember exactly the numbers that I sold it at or anything like that, but you get the idea, the thought process. So I know that, I'm probably, when you sell on the way up, it's probably going to keep going up. If you bought a good stock, if the market's good, why should it just stop going up just because you sold it? So I'm comfortable and know that it's probably going to keep going up. I usually take it off in bite-sized morsels on the way up, with the idea that, I'm probably going to be wrong the first time. So I might sell it a little at 33, a little at 34, a little at 35. And in the end, I get, 34 or something like that. So risk mitigation is protect yourself from mistakes that you would make. And a lot of that is just kind of studying your trades. Where'd you buy? Where'd you sell? And if you're honest with yourself, if you look yourself in the mirror it's sometimes I think it's, you know, it's fairly clear where you're weak in the market and where you're strong. And for myself, you know, I know that. I know what I'm really good at, and I know what I'm not so good at. And I try to make myself very aware of putting myself in a situation that I'm no good at. Like Fed days. I despise Fed days. I've lost so much money on Fed days. It's ridiculous. So I just don't trade on Fed days. You know, when the Fed makes an announcement, I just, if I have something I like, I'm allowed to keep it. I'm not allowed to put on any trades between 10 and 12 o'clock Pacific time. The Fed usually comes out with their information at 11:10 Pacific time. So I have a rule. I cannot do anything new at 10 o'clock all the way till 12 o'clock. And sometimes I stretch it even longer. I'll wait near the close. I really want to see how it closes if I really want to do something new. Because I've just found that from studying is to make too many mistakes in that time frame. So stop doing that. Okay, Marcus Smith at investors.com, 800-424-9033. I think the market's definitely open this Monday, but the following Monday, I believe it's closed. So, but I should be back next Friday with a new video. Thank you guys. I appreciate all the feedback that I get. I know sometimes I can't do these videos every week. So I know I really appreciate, I really like hearing from you that, you know, a lot of you guys like to see these each week. It's good news. But sometimes life gets in the way. Have a great weekend, everybody. Thank you. Bye-bye.